Okay, this problem is one of the ones you'll see on the Chapter 5 exam. It's just like your homework problem, 5-19A. So you can review this and you're going to also practice this if you want to. So here we go. All right, this problem we have Mason Company, and there's for information for year 2. They started with a beginning inventory of 130 units and they paid $50 a piece for these units. Then they purchased 400 more units at $52 a piece. And it says their ending inventory consisted of 90 units. And we know that because Mason sold 440 units at $104 a piece. So we know they had 90 units left because they had 130 units plus 400 units, or they had a total of 530 units available to sell. They sold 440 of them, therefore they had 90 left in their ending inventory. Now, all purchases and sales were made with cash. Very important sentence there. All purchases and sales were made with cash. Operating expenses amounted to $3,000, and again, these operating expenses were paid for with cash. Required, step 1. They want you to compute the gross margin for Mason Company using the following cost flow assumptions: FIFO, LIFO, and weighted average. So under FIFO, the first thing that comes in is the first thing that goes out. And they want the cost of goods sold. Well, the cost of goods sold, or excuse me, they want the gross margin. So gross margin is basically sales minus cost of goods sold equals gross margin. So let's run these numbers through here and see what kind of gross margin we get under FIFO. First thing in, so first thing out. So before we show the numbers, if it's FIFO, first thing is the first thing out, and we sold 440 units, that means we sold all of these units because these are the first ones we had. We sold all of these, and then we sold, let's look like 440 minus 130, which would be like 290 of these units. So let's take a look and see. So here's our sales under FIFO, 440 at 104 a piece. That corresponds to what we had up here. And that's total sales of $45,760. Then our cost of goods sold under FIFO, first thing in is the first thing out. We sold all of these units that we bought at $50, all 130 of them up here. So that's $6,500. And then we also sold 310 of these units that we bought for $52 a piece. And that makes up the total of 440 that we sold, right? And that's going to be 52 times 310, which would be $16,120. Add these two together. This is our cost of goods sold. Our cost of goods sold is subtracted from our sales to come up with gross margin under FIFO. And that's going to be $23,140. Let's go to LIFO. LIFO says the last thing in is the first thing that goes out the door. So we have our sales, just like before, no difference there. 440 units at 104, $45,760. Now under LIFO, if we sold 440 units, that means we sold, the last thing in is the first thing out. We sold all of these units, right? Because these are the last ones in. We sold all of these, plus we sold 40 of these. So here we go. We've sold under cost of goods sold 400 units at $52, which is $20,800. We've also sold the beginning inventory, 40 units there, which makes our total of 440 at $50 a piece, which is $2,000. Add the two together, and that's our cost of goods sold of $22,800. Subtract that from our sales, and we get gross margin under LIFO, which is going to be $22,960. Now the third calculation is for weighted average. So here we go under weighted average. Our sales, just like before, no difference there, $45,760. And then our cost of goods sold, we got to make a calculation for what weighted average, not simple average, but weighted average is. So our average cost per unit, if we sold 440 of them, is going to be an average weighted average cost of $51 Now that little 1 there means that we had a separate calculations, which I'm going to show you. So we want to take the $6,500, which is 130 times 50. That's $6,500 there. And we also want to take the $20,800, which is 400 units times $52. So now we've got the total cost of all these units available, which is the beginning inventory plus the units purchased. The total cost of all the units available were $27,300. Divide that by the total units available, which is 530. That's 130 plus 400, or 530. And that 530 divided into 27,300 gives us a weighted average cost per unit of $51.51. Now, we have a second calculation. So we're going to take 440 times $51.51, and we're going to multiply the two together, and we're going to get, just a second here, rounded to the nearest whole dollar, we're going to get $22,664. That will be our weighted average cost of goods sold. Subtract that from our sales of $45,760, and we're going to get a gross margin here, which is the third calculation, gross margin there, of $23,096. That takes care of part 1 of the problem. Part 2 of the problem, they want to know what is net income. Well, net income is going to be just these gross margins we just calculated. You go back and look at the other video part of it, and we've just calculated gross margin for across these three things. And now let's take these operating expenses that we were given and subtract those out to get net income, because sales minus cost of goods sold equals gross margin minus operating expenses equals net income. So our expenses are the same, 3,000, 3,000, 3,000 under each of these scenarios, and we get net income then of 20,140 for FIFO. LIFO's net income is 19,960, and weighted average income, net income, is $20,096. So that's part B of the problem. And then part C of the problem is as follows. They want you, in part C, it says determine the cash flow from operating activities using each of the three cost flow assumptions listed in requirement A. So here's FIFO, LIFO, weighted average, and you have to ask the question, well, what kind of cash flow do you have under operating activities when you have sales and expenses? Well, sales is a cash inflow because you're getting cash, because it said in this problem that all the transactions, all of them, were in cash. So your sales were in cash, all your expenses were in cash, and your inventory that you purchased all was in cash. So under under cash flow from customers, we just take our sales. And our sales were, we sold 440 units at $104 a piece. So all of that under all three of these pieces of situations, that's how much cash came in from customers from sales, $45,760. So that's our cash inflow. Our cash outflow is a little more complicated here. Not much, but a little bit more. So we've got two kinds of cash outflows. In this problem, if you go back to the very beginning, you'll see that we purchased some inventory and we had some operating expenses. Purchased some inventory, had some operating expenses. So here's how you calculate the cash outflow that are operating activity outflows for under each of these three scenarios. We purchased for cash, remember cash, 400 units at $52 a piece. It doesn't matter how the cost flow of these things were, whether it's FIFO, LIFO, that doesn't matter. All that matters is how much cash went out the door because of this inventory. And what in this situation is 400 pieces at $52. That's how much we spent on inventory. And then we'll add to that our operating expenses, which amounted to $3,000 under each scenario. So we had a total cash going out the door for operating activities of $23,800. And that's under each of these things, each of these pieces. And so the net cash operating activities, net cash flow, would be the difference between the cash inflows and the cash outflows. And that's going to give us the same under all three of these, because we're not trying to figure out a cost of goods sold or a gross margin. We're just trying to figure out how much cash came in, how much cash went out. So the answer for under all three of these alternatives is the same, $21,960. And that is how you solve homework problem 5-19A, which will be part of the test.